This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, I've got to tell you, it is a great day to be in Tokyo today because we just had that Japan GDP figures coming out in the last few minutes, revised numbers for the fourth quarter and telling us that actually Japan managed to avoid a technical recession. So something very, very interesting to note as we count down to that BOJ decision due just ahead. Could actually be setting the stage perhaps for the BOJ to pivot away from its easy policy settings finally.
Yeah, just one more piece of the puzzle, right, as you get that incremental sort of drumbeat towards when will they get on that path to policy normalisation. We know the wage negotiations wrap up this week as well. If you take a look at the direction when it comes to the upside bias in JGB yield, certainly that case is really starting to build with the additional momentum. We did have that report as well that the BOJ is considering scrapping YCC, but take a look at certainly equities are kind of trending in the opposite direction.
Yeah, that's right. You've got the stage that was sort of set for US stocks, or rather Japanese stocks, by Wall Street. Again, we had that slump into the close on Friday. So we had a pretty mixed jobs report coming out, but certainly the expectations for the Fed are going to be set by the US inflation print that's due Tuesday. That could show a bit of an acceleration again, certainly telling us that the Powell unlikely to have that base case ready to turn firmly dovish. So that sort of plays into the dynamics we have for Japanese equities here. You're seeing both the topics, the Nikkei 225 dropping more than 1% so far, and we're tracking those tech stocks in particular. There's the US side, and then there's also what's happening with the Japanese yen, because you're strengthening here again, where we've had gains against the greenback for the past 4 weeks or so, back below that 147 mark as well. We had really been trending around the 150 region for quite a period here, but the numbers that we're really tracking today, as we said, it's all about Japan escaping technical recession in the latest period. So GDP expanding at an annualized pace of 0.4% in the final 3 months of last year. That reverses an earlier 0.4% retreat that initially had been reported. So certainly something to keep an eye on. And again, as you say, those ramifications. What does this mean for the BOJ? Could we see any sort of policy shift as soon as the March meeting? So that's Japan, but let's shift now to what we've got for Korea here, because we're also taking a look at what's happening with trade numbers that are just coming out, because we've seen that deficit coming in at $1.26 billion. We've also seen imports as well dropping more than 28%. Exports is really the one that we should be keeping an eye on here, and we saw that dropping again, 13.4% on the year. Japan, or Korea rather, really seen as a bellwether when it comes to exports data. It's also one of the first to report, given we get these early numbers coming through. But certainly exports, that's not a good number there to see it in contraction territory. We have seen it rising over the past period here. But Korea, they're the exports or trade numbers we're keeping an eye on, and weakness coming across in the equities landscape as well, Haidi.
Yeah, weakness here in Australia as well, Belle, after we saw stocks really managing to end the week climbing the most in 5 weeks, largely on sort of the optimism when it comes to the rates outlook. We are seeing a down day here in Australia. Sydney stocks off by just about 1.25%. We're seeing the biggest laggards as energy down by almost 2%, but really just about every sector are in the red. But materials and energy, very growth sensitive areas, are leading those declines. Watching the Aussie dollar, 66.23 is where we're trading when it comes to the Aussie, and we are expecting to see kind of more of that benefit when it comes to the weakness in the US dollar that we've seen over the past couple of sessions play out here in Asia, particularly, of course, when it comes to the yen, but certainly some of the more growth-sensitive, sort of China-sensitive proxies like the Aussie seeing a little bit of weakness there, despite the softness in the US dollar that we see. Looking at oil, as I mentioned, it was one of the biggest losers as we see sort of sector-wise here in Australia, seeing Brent trading just under $82 a barrel, holding on to those losses ahead of US inflation data. We also have reports from OPEC and the International Energy Agency due out this week that could give some clues on the demand outlook. Those monthly market reports will be closely watched, but we did see that decline of over 1% for Brent in the Friday session, and that's really carrying through that possibility possibility of more heated US inflation that expected on Tuesday, also posing to be quite a key risk for monetary policy. So we are seeing quite a bit of caution, though. But last week, I should point out, was actually the least volatile week since 2021 for oil, as we continue to see kind of the juggling of these supply and demand factors for traders. And taking a quick look at treasuries, and of course, what we get out of that inflation number this week will feed into expectations when it comes to Fed speak and Fed expectations as well, right? The US CPI really firmly in focus at this point, as sort of how bond traders will be watching the next big move. This is the own, if you will, Super Tuesday of sorts. We've got the fresh inflation data, and that'll feed through to when the Fed might start cutting rates. And of course, it comes on the back of what was ultimately a little bit of a confusing picture given by the jobs report on Friday. Well, our next guest says that most sectors, when it comes to the equity markets, will be supported by positive earnings revisions in the next 12 months. Let's bring in Junbei Liu, who's a portfolio manager at Tribeca Investment Partners. And you guys are always pretty pragmatic, so you do still see ample opportunities going forward.
Look, absolutely. Look, we think the equity market is not a doom and gloom as many have suggested. We think the fundamental looks good, particularly for some of the cyclical sectors. Now, the valuation may be a little bit stretched for some of the growth names, particularly when it's AI or tech focused, but we do think majority of the sector are doing quite well. The latest reporting season, earnings season around the world have really demonstrated that the analysts were too conservative. The earnings recession that we're looking at, or consumer recession we're looking at, is not as bad as expected. We will see slowdown in consumer spending and corporate earnings, but the expectations are far more pessimistic than expected. So we do think next 12 months for cyclical sectors is actually looking pretty good.
So you're looking pretty balanced, because even as you say, yes, valuations for some of the growth tech-related names are looking pretty peaky, but the narrative is still strong.
Oh, absolutely. So I do think that this whole AI thematic is real, and as an investor, you just cannot ignore it. You may well say it's too expensive, but you've got to be there in one way or another. Here in Australia, it's a little bit harder to play, but in the US, there's your playground is enormous. I think that those sort of sectors, it is a buy on the pullback. Probably chasing it is a little bit difficult, but on a buy on the pullback is very important to have it as a part of the portfolio, while at the same time, it will pick up some of the cheaper sectors where the earnings will be upgraded and valuation will grow in the next 12 months.
Last day of the MPC today. Normally, of course, investors will be able to glean a little bit more from the Premier's press conference. That's been scrapped. Is that worrying for a China investor in that we didn't really get much detail as to how they plan to support that 5% target?
Look, that's the thing, right? So it is somewhat disappointing, and then that's why you're seeing quite a lot of offshore investors selling China, whereas domestically it does seem like the commentary is supporting a bit of confidence domestically for the domestic consumer. It is disappointing. We didn't see big stimulus, but I think the expectations were pretty low for that. Investors will look forward to more details about the rate cuts, which is signified, and also, potentially what else is to come through. I think the risk at this point, there's a little bit of negativity about, what's the upcoming quarterly result for the Chinese companies because of the tough stance on financial fraud and the like. So we'll probably will see more losses, and what the government is doing in terms of support for the equity market over there. So, the bit of uncertainty, but net, it's in line with expectations.
And what do you think investors will sort of be most focused on? Do you think it is that earnings story, or do you think if we get any sort of rate cuts that's been indicated, as you say, is that going to be something that sort of prompts, perhaps if not a pickup, at least stopping the selling?
Of course. Look, I do think the Chinese market is very attractive, and the economy is recovering, but just very slowly. The rate cut will come, as indicated, but the thing is, it's really about the consumer having more confidence and spend. We saw a glimpse of it at the Chinese New Year travel stats and the like. So we do think it is happening. It's just in a slow way. But as investors, looking into China, the valuations look very attractive, and as the consumer recovers, I do think they're more confident will return to that market.
So which sectors are you sort of looking at in particular then?
Look, absolutely. So for that market, you absolutely want to focus on the services and, so the likes of travel, the services, because the next few years there will be huge not revenge spending, but huge catch up in some of the lost spend over the last few years. The consumer want to spend and they want to travel around. That is an area where you really want to focus a lot of attention. And I do think these will benefit the surrounding markets as well. Markets like Australia and the like, because, we generally take big intake of Chinese tourists and travelling and students.
So those are the proxies that you'll be playing when it comes to the Australian market?
Absolutely, yeah.
In terms of the property sector, do you see that as being an impediment to market sentiment improving?
Look, in terms of the property sector, so if we're talking about, China is important because it's where locals, the local individual consumer will be focusing on. I do think if things stop getting a whole lot worse and a lot of negative news headlines out of the way, and there's been enough support for that space, it is stabilizing, it is getting better. So, we think net, the fact that the Chinese market has been very strong been improving for quite some time. I do think the confidence is returning. And for the other market, look, property is important. I think, here in Australia that, our property market is picking up quite strongly as well, just given the sort of travelling and immigration stats and the like, and the shortage of the bill here in Australia. The pipeline is actually looking very strong for this sector. So every market is quite unique where it stands.
That was Junbei Liu there, portfolio manager at Tribeca Investment Partners, and we're just 10 minutes into the session so far for Japan and Korea today, and there's some notable losses that are coming through in the session so far. Actually, every sector is in the red, but IT is among the sectors that's most underperforming in the session so far. What's driving that is actually what we had in the US session to end the week. So it was weakness came through. We saw the likes of Nvidia and other tech stocks dropping, but Nvidia down more than 5%. That was the biggest decline since May 31. It is that story. Perhaps we've got valuations sitting around a 2-decade high, a bit of profit taking coming into it, a bit of just broader uncertainty in the direction for markets. But you do see that weakness coming through for tech stocks so far. Samsung, you can't see there, or SoftBank rather, but it's down more than 4% at this point, and that's the biggest decline since November. Let's switch over because there's another name that we're tracking in the session today, and this is actually one that's moving to the upside so far. The Japanese pharma company Eisai. What's happened here is that Eli Lilly, it's a competitor pharma company that's listed in the US. Its Alzheimer's disease drug is facing further delays in gaining US approvals. Regulators want to hold a hearing to see how safe the therapy is, how well it works. And so this is actually something that is a negative overall for of course, dementia patients, but Eisai, given it does have its own Alzheimer's drug that's already approved, it is gaining off the back of that delay for its competitor Lilly, or Eli Lilly there. But that is one of the other stocks we're focusing on today, Heidi.
Still ahead, here Aberdeen expects both the Fed and the ECB to start cutting rates in June. Their senior economist will be with us later this hour. Before that, though, we'll be headed back to Beijing as China's National People's Congress draws to a close today with an ambitious growth target and a fresh warning about property speculation. This is Bloomberg. China's annual session of Parliament, the National People's Congress, wraps up in Beijing in a few hours with perhaps more emphasis on what leaders did not do and say than what they did. Let's get over to Beijing. Our Chief North Asia correspondent Stephen Angle is there with us. And as you said earlier, it's sort of more of a whimper than a bang to the conclusion of the MPC this year.
Yeah, I think the NPC, and I've covered a lot of them, was a bit truncated this year. It was just 7 days instead of between 10 days to even 2 weeks in some cases in the past. And there's not going to also be a press conference today at the conclusion of the National People's Congress. Of course, much has been made about that, how the Premier Li Qiang will not be addressing the media. So we can't necessarily get some clarification. Yes, they're fairly, scripted, and the playbook is pretty well known, but at least we get to put questions to the Premier usually to get clarification on the policy that he gave us a week ago in the work report. The work report, too, was sort of truncated last Tuesday, just under an hour. Sometimes they go well into a second hour. And also, an interesting point, too, when I say it was truncated, for the first time since 2019, Li Qiang last Tuesday in his work report omitted the very common phrase that housing is to be lived in, not speculated on. That is something Chinese party officials have been talking about consistently since about 2016, in fact, as kind of a precursor to what we've been seeing is that crackdown on speculation and, of course, over-leveraging in the property market. He left that out. However, in a press conference yesterday by the Minister of Housing and Urban Rural Development, Ni Hong, he said, we must adhere to the very end the belief that housing is for living in, not for speculation. So at the very end of the NPC, they kind of gave new life to that sentence that they've been uttering since 2016 to kind of hammer home the point that they're not going to ease up on their crackdown on the property sector. And it is a topic that was not really mentioned much other than seeking high-quality development. They did not talk a lot over the course of the last week about the problems in the property sector, which are huge, to say the least.
Yeah, huge, and something that's going to be persisting for perhaps multiple years, Steve. But property is so closely tied as well to consumer confidence, and something that perhaps policymakers could take some heart in is that we saw CPI rising in the latest reading.
Yeah, it's the front page news in the China Business newspaper today, and CPI better than expected. We basically broke 5 consecutive months of CPI deflation. Keep in mind, we're still in deflation on the factory gate on wholesale prices, but CPI did break the pattern. It rose for the first time since August, up 0.7%. The consensus estimate was for 0.3%, so it was better than expected. But keep in mind, February and January are always aberrations on these kind of numbers, simply because, the Lunar New Year holiday. And yes, we had record travel. We had record spending, not per capita spending, but overall spending. We had record box office receipts. So there were some really good indicators coming out of the 2-week travel period in February that really boosted those numbers. Now, we have to see whether that's going to carry over, and traditionally it does not carry over. It's great headline number. It's front page news here because it shows sort of an ending of the trend of deflation, but it does not necessarily, is not a harbinger necessarily that things are going to be better going forward, because consumer confidence is still pretty weak here.
Yeah, that was Bloomberg's Stephen Engel there. And Steve, really to your point here, because we've got the latest Bloomberg Markets Live poll survey coming out, and it's still suggesting that a lot of investors are concerned about China's economic and also its financial problems, despite Beijing, of course, again targeting that growth of around 5% for the course of this year. The poll also found that 30% of respondents still do not have any exposure to China whatsoever, with another 20% planning to pull back over the coming 12 months. Here's what some of our guests have been saying about the problems that are facing the world's second biggest economy.
Our view is that one should not invest in China.
I don't think it's uninvestable per se.
High dividend and clients asking for income definitely will still continue to play.
You got to be very, very careful if you're investing in China right now.
We think the economy is going to steadily continue to slow down for the next 10 years.
I think the biggest risk here is policymaker complacency.
It is not clear what the overall general direction of policy will be long term.
Stimulus is important, but I think China has passed the stage where they want to throw a lot of money, build a lot of leverage.
We're in a new paradigm The leadership's economic priorities are completely different.
It's very difficult to restore the market confidence.
The sentiment is really bad. I talked to my friends in China, and they're talking about that there is no hope.
I think it's going to be a harder challenge to bring the foreign investors back to China.
For more, let's bring in our Asia equities reporter Charlotte Yang in Hong Kong. And Charlotte, I think when you stack up what came out of the MPC, you put it against the structural, the cyclical problems that are in China's economy, it really does seem like there's not any catalyst here to have any sort of market rebound.
Yeah, Alice, I think that's what we see from the MLive Pulse survey with over 230 respondents, including retail traders as well as professional investing community. When they were asked whether you plan to increase your China's assets position in the next 12 months, we actually see about an equal size of respondents that say that they plan to increase as well as or decrease. So I think this shows you that even though the Chinese equity market has been rebounding over the past months, the MPC as well has not been able to give investors enough confidence. And you have about 3/4 of the survey respondents say that they are somewhat very concerned about the problems from China's economy as well as the market spilling into the other rest of the world. And this kind of underscores global investors' concerns about due to the size and the importance of China's economy. In the absence of a strong stimulus, the kind of slow economic recoveries will make it vulnerable, especially to economies that rely on China as a key export destinations. And I think, also another thing that stood out from the survey is that we have more than half of the respondents say that they expect that in a month's time that the key results from the National People's Congress will be irrelevant for the equity market. I think this confirms, given that this confirms that going forward, it will be hard to find that one big catalyst that will be able to improve the market sentiment on a broader level.
There are some concerns from respondents that we're going to see that the Japanification of not just the Chinese economy, but what we saw reflected in markets, right?
Yes, there are also a great number of respondents say that they see the sizable risks of China equity market fall into the kind of extended slump we saw with the Japanese market in the 1990s. And also with, I think, the MPC was a big catalyst people were expecting to, but even though the economic growth catalyst was seen as very ambitious, there was a big gap between that left among investors' mind, how do you achieve that GDP? And with that, especially the weaker than expected fiscal target, according to Morgan Stanley, that could create, elevated volatility for the market because that could spill yield for the earnings. And I feel like because of the slow earnings recovery as well as the lack of a strong stimulus from the macro side is why some investors might be concerned about extended slump for the equity market for China.
Our Asia equities reporter Charlotte Yang there in Hong Kong. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers can get that at Daybreak Go on their terminals. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings so you just get the news on the industries and assets that you care about. This is Bloomberg.
You're watching Daybreak Asia, taking a look at some of the latest political stories that we're tracking this morning. And President Biden has warned Israel against invading the city of Rafah in southern Gaza as ceasefire talks with Hamas remain deadlocked. Washington had been hoping for a breakthrough in the negotiations before Islam's holy month of Ramadan, which began Sunday. Biden says the US will continue to lead international efforts to get humanitarian assistance into Gaza and push Israel for more routes to deliver aid. Australia will scrap import tariffs on a wide range of consumer goods from July in a bid to ease household expenses and business costs. The government says almost 500 of what it calls nuisance tariffs will be abolished on goods including washing machines, toothbrushes and pens. It estimates companies will save almost $20 million a year in compliance costs. India has signed a free trade pact with 4 European countries that the Modi government says will create 1 million jobs in 15 years. The deal with non-EU countries, including Switzerland and Norway, has been 16 years in the making. India gets private sector investment commitments in return for the Europeans securing easier access to Indian markets and products. The Biden administration is said to be weighing sanctions on several Chinese tech companies, including chipmaker Changxing Memory Technologies. Sources say the Commerce Department is considering adding CXMT and 5 other Chinese entities to the so-called Entity List, which restricts companies' access to US technology. CXMT competes with the likes of Micron, Samsung and SK Hynix. Coming up, Aberdeen discusses its rates outlook and why it expects both the Fed and the ECB to start cutting in June. Its senior economist is joining us just ahead also to discuss the outlook for the BOJ, but we'll have more ahead on Bloomberg. This is Bloomberg.
A lot of risk aversion here in the early part of the Monday morning session here in Asia. Take a look, a sea of red really across the board. The Nikkei 225 off by just over 2% there. We are seeing, of course, quite a lot of fluctuating expectations out of the Bank of Japan. We had the revised GDP data suggesting that the economy avoided a recession just a week before that Bank of Japan meeting there. And that will just be one of those additional data points kind of in play as we get into further expectations. And the cost B is also softer by about 0.5%. We had some pretty poor trade data out in the last hour or so. We're also seeing downside here in Australia. In fact, this is the biggest intraday decline we've seen for Australian stocks in about a month. All sectors dropping, but really especially being led by a lot of the growth-sensitive sectors, including the likes of energy as well as miners, the biggest laggards, that down almost 2% apiece there. Kiwi stocks also following the broader trajectory of the region. And of course, when it comes to some of the other moves we're watching, of course, a dollar weakness, yen strength story continues to play out, as well as JGB yields headed towards those November highs. That YCC exit is in place. But take a look at Asian chip stocks in particular as we continue to sort of watch the narrative when it comes to Nvidia and some of the valuations that we've seen. We did see, of course, in the past week, Nvidia seeing that biggest drop since August, but of course some profit taking perhaps after an almost 20% 6-day gain there. We are seeing the likes of SK Hynix there, one of the biggest losers, up at 3.6%, and Advantest over almost 6% lower there, Belle.
Yeah, Heidi, that's certainly one of the big sectors we're tracking this morning. But on the eco front, it's that big watch on Japan's GDP, because we had that revision coming through for the fourth quarter numbers earlier, and it did reverse a quarterly contraction into positive growth, and importantly as well, avoiding a technical recession. So that outcome could support the case for the BOJ to end its negative interest rate policy this month or the next as well. Let's bring in our Japan economy and government editor, Paul Jackson, here in Tokyo. And Paul, start us off here, because, yeah, we had it in negative territory for the preliminary readings. It was reversed for the one that just came out this morning. What was it that really created such a difference there in the preliminary and the final readings?
Well, it's a common pattern that we see in the GDP data coming out of Japan, is that after the preliminary figures are released, we get a survey of capital spending by companies. And the spending figures that the Ministry of Finance released were kind of gangbusters, like very, very positive in terms of business spending. So that suggests companies are a lot more upbeat than was previously thought, and they were spending a lot more. So I think economists had all expected really that we were going to flip back into positive growth in the last quarter. And hey, you know, for a central bank, if you're trying to, you know, pave the way for an interest rate hike, and you want to move, it's a lot better look for you if the economy is growing at the time rather than contracting. I think the history books would look pretty challenging for Mr. Ueda if he raises rates while the economy is contracting and things then didn't go well. So it's the kind of thing you want to avoid as a central banker.
We can get to the BOJ more in just a moment, but I want to also understand first, because the reading came in at 0.4, but the consensus from the survey had been 1.1% expansion. So why was it actually a bit weaker than what economists had been expecting in light of those capex numbers?
Well, I think that overplayed a little bit how much the capital spending would improve the revised figures. That's point number one. I think there are still signs of, concerning weakness in the economy, and that's the private consumption. Inflation has been eating into households' purchasing power. They've been able to spend less, and we're still seeing that happening. Now, that's an interesting point because the Bank of Japan is saying it's looking for a positive growth cycle where, inflation is feeding wages and improved consumption. So at the moment, there's not a great deal of evidence that we've got the improved consumption because the private consumer spending has been falling for the last 3 quarters.
Yeah, the demand side does look pretty wobbly, right? And I do wonder when it comes to the spring wage rise demands, are they going to be strong enough to give the BOJ the conviction that they're going to want to see?
Hey, look, I think that the BOJ is not going to be derailed from going ahead with this rate hike either this month or next month. And I think what we saw with last week's average demands released by Rengo, the top union federation, is that the wages are going to come in strong. Now, that result is due Friday. Most of the unions are filing their wage deals. Many of them are on Wednesday. Figures will be collated. They'll come out Friday. And I think we're going to see a pretty big number. And that combined with this GDP figure, I think we've got plenty there to justify a possible move in March. But that's still not a done deal.
All right, Paul, that was Paul Jackson there, our Japan economy and government editor here in Tokyo this morning. And let's get more on the outlook for the BOJ and bring in our next guest. This is Luke Bartholomew, senior economist at Aberdeen this morning. And Luke, as we were just discussing there with Paul, perhaps the stage could be set now for the BOJ to pivot or change its policy settings as soon as this month. I'm curious, what's your view on that?
Yeah, I think every meeting is live, right? That's the key message when it comes to the Bank of Japan. Whether it's March, whether it's April, a lot will depend on what the Shinto looks like on Friday. I mean, I think it is true that it wouldn't have been a good look, so to speak, had the Bank of Japan tightened when it turned out that the economy was still in recession. With that recession being revised away, maybe that makes March a little bit more live. But I think, really does it matter massively whether it's March or April or even a bit later than that? No, I think the direction of travel is clear, that tightening is coming, and the Bank of Japan, therefore, is a standout compared to a lot of other developed market central banks.
And there's a few different levers, of course, that you can pull on here. Where are they most likely to focus shifting their policy settings first, do you think?
So I think it will be a simultaneous move, both negative interest rates and yield curve control lifted at the same time. I don't think that there's any particular need to be clever around the sequencing of that. I mean, there had been some speculation that maybe yield curve control would be the first thing to go. Perhaps that was more distortive of markets, and clearly the Bank of Japan has been backing away from that for much of the last year or so. But I think at this point they're quite happy to lift yield curve control and negative interest rates at the same time.
Luke, what's not clear in terms of the direction of travel is China, right? Did you learn much as we wrap up the National People's Congress today, given that there seems to be less transparency as to how they plan to hit that around 5%?
Yeah, look, that growth target does seem very ambitious, to say the least. And you're right, it's not obvious how it is going to be hit. I mean, we're looking for growth that's much closer to 4.5% than 5%. Given the significant headwinds from the property sector, given the lack of interest in unleashing what you might call big bang, big bazooka stimulus, wanting to hold the line on de-risking there. So whilst we'll continue to see some incremental easing, I think the clear lesson is that, more aggressive stimulus than that isn't coming. And for now, the growth target, I think, is pretty unachievable.
Is the economy, are asset prices facing a inevitable Japanification, do you think, in China? Or do you think there is still an opportunity, I guess notwithstanding what happens this year with stimulus, to be able to lift from that deflationary demand cycle that it's in at the moment?
Yeah, I think something like, a 30-year battle with disinflation, deflation that's connotated by that phrase, Japanification, is probably a bit strong. I think maybe the risks of that are slightly overdone. When Japan fell into its deflation trap, it was already a rich, very well-developed economy. China is not at that stage of its development. There is still plenty of low-hanging fruit to pick when it comes to catch-up growth and development. It still has a number of important drivers of growth, both the traditional ones about moving people into higher productivity sectors, but also, more forward-looking modern drivers of growth around the green transition, the technology sector. And on top of that, policymakers have learned an important lesson from the Japanification experience. And whilst big bang stimulus isn't happening, I don't think that policy is going to be so weak that it allows for, the economy to fall into a very deep deflationary trap.
US inflation numbers, that's one of the big data points that we're looking ahead to this week. We're likely to still see that moderation trend intact. But how do you think that that number is going to stack up against that jobs report we had Friday in terms of the outlook for the Fed?
Yeah, so January was a big inflation month right across CPI, PPI, PCE, all of those measures a bit stronger, and that reignited some concerns about this so-called last mile on inflation. I mean, my sense is that the employment report on Friday, the payrolls report, helped ease some of those concerns. It's been described by a lot of people as mixed, but my take is that it's actually a pretty good report from the perspective of the Fed, consistent with the economy still ticking along, but underlying wage growth easing somewhat. And I think that this week's inflation report will sort of confirm that story, that whilst there will be bumps in the road on inflation, that we shouldn't be concerned about an aggressive pickup in inflation from here. The underlying inflation dynamics are going in the right direction.
It's been interesting sort of to track, of course, with all of the global central banks, but that sort of race between the Fed and the ECB, who would be cutting first? Now it seems like markets are sort of aligned on when we'll start to see any sort of reduction.
Yeah, it has been quite the horse race over the last couple of months. I mean, so I think we're broadly aligned with markets where they've got to in terms of a June start for both the ECB and Fed. I mean, it is worth saying that whilst they'll be cutting around the same time, that they will be doing so for rather different reasons. I mean, the European Central Bank will be easing policy for the pretty straightforward reason that growth is extremely weak. I mean, the Eurozone seems to have just about avoided a technical recession by the skin of its teeth, but the underlying health of the economy is extremely weak, and therefore that's sort of doing the job of getting rid of inflation. So the European Central Bank cutting for economic weakness reasons, whereas the Fed is cutting much more from a position of strength. The US economy continues to be pretty solid. It's just that we've had this very strong supply-side environment which has allowed growth to be strong and inflation to fall at the same time for much of last year. And so the Fed can be taking its foot off the brake with those inflation concerns fading, even as growth stays pretty solid.
Luke, really great to have you with us. Luke Bartholomew, Senior Economist at Aberdeen. Well, coming up, Asia's earnings spotlight shifting to iPhone manufacturer Hon Hai this week. We'll be discussing how Apple's China woes could impact those results next. This is Bloomberg. Foxconn's public arm Hon Hai is headlining Asia's busy earnings week. The maker of Apple iPhones will report results after sales of the product fell in China quite sharply in the first 6 weeks of the year. For more on this, let's bring our breaking news earnings specialist, Rachel Yeo. So, Rachel, we know that Apple's got a number of woes, and plunging sales in China is certainly one of the big ones. Are we starting to see that play through to suppliers like Hon Hai?
Yes, we are seeing Hon Hai offering insights to China's tech sector amidst a weak economy. So the company does face some challenges after Apple reported, Apple saw that iPhone sales in China has dropped 24% over the first 6 weeks of the year. And also, Hon Hai also reported an 18% slip in sales for the first 2 months of the year. So this is concerning because Hon Hai gets half of their revenue from Apple. So its outlook during its earnings will be the one to watch over the coming week.
It's not just, of course, Hon Hai. There's actually quite a number of big companies as well. Cathay Pacific, you've got the EV maker, or battery maker rather, CATL. They're also on the docket. So what are we expecting from those companies?
Yeah, we are expecting Cathay to extend annual growth, annual profit as they continue to recover from the pandemic. The carrier will also benefit from pent-up passenger demand as, with China opening up last year, the number of passengers has been steadily rising throughout the year as well. So there will be some advantages over that. And also, Cathay is also expected to resume paying its dividends in 2024, so investors may be keeping an outlook for its cash flows. For CATL, we are expecting to see profit rise for 2023 as the company continues to benefit from its new energy business. In the long run, the battery maker should be able to brave price competition thanks to its scale and cost advantages. They are also able to capture the growth of electric vehicle sales in China as well.
Rachel, we're also watching Samsonite earnings, right? Can you tell us more, given they've been eyeing the exit in terms of delisting out of Hong Kong?
Yes, with Samsonite's potential plans to delist from Hong Kong, it could signal the likelihood that they may see smaller scale gains in the Greater China region as compared to other regions as well. But in terms of its full year earnings itself, we're expecting to see a jump in revenue as they benefit from a resurgence in travel demand.
That was our breaking news earnings specialist there, Rachel. Yeah.
The latest corporate headlines that we're tracking, Bloomberg has learned that Reddit and its investors are looking to raise as much as $748 million in an initial public offering. Sources say the social media platform plans to sell shares in a range of $31 to $34 each, seeking a valuation of as much as $6.5 billion. Reddit has been working towards a listing since its initial filing in 2021. Saudi Aramco is raising its dividend despite lower profits to help the government plug its budget deficit. The total payout for the fourth quarter has been set at around $31 billion. If it maintains its pace, payouts for the year will be up 66% since 2021. The world's biggest oil exporter provides much of the Saudi government's income via generous dividends. More ahead on Daybreak Asia. This is Bloomberg.
We're heading through the morning session so far, and one group of stocks that's really standing out to the downside here are the tech names, and ones that are linked to the chip sector in particular. Here you're seeing that drop coming across the likes of Advantes, SK Hynix, SoftBank. All of these are really seeing quite a bit of weakness. It does track the Wall Street session because we had a decline coming through for Nvidia, so down around maybe perhaps down around 5.6%, not maybe, but it was down on to the Friday close. A little bit of profit taking still because you've had a big run up over the past 5 sessions or so. In that chart there over the past 7 days, you're still up 10%. And when you take a look at the gains, say over the past year, you're looking at an upside of 280%. Now, there's a key investor that's really missed out on that, and that's Cathie Wood, because she sold Nvidia holdings ahead of that giant rally. We asked the ARK Investment Flagship Innovation ETF, the CEO of that, Cathie Wood, whether she regrets that decision.
We wrote it most of the way up, but I'll tell you what we did. And this is, as a portfolio manager, it's not one action, but what it causes in terms of another action. Last year, we sold in the flagship NVIDIA and put it into Coinbase. Coinbase, I believe, is up at least as much as NVIDIA. And it is much less well understood. The whole crypto movement, the crypto asset movement, Bitcoin as a new asset class and so forth, is not well understood or completely accepted out there. So we prefer to go where others are not traveling as much. And, as we were moving out of NVIDIA, we were saying, okay, regulators are trying to crush Coinbase here, and we were buying it on every dip. NVIDIA happened to be one of the sources for that purchase. So it's not just what we do on the sell side; it is what we do on the buy side that you have to look at. And yes, we do hold it in the more specialized funds, but we've been taking profits there as well for reasons I just described.
Yeah, and to be fair, you're right. Coinbase is up about 620% since the end of 2022. So that compares with about 530% gain in NVIDIA. Is there anything, though, Kathy, in the NVIDIA story that would make you rethink the name and want to become more aggressive on it?
Yeah, if the price came down a lot, we would. The rate of return expectations
or a split.
We have.
Would a split do it? Because I know we've been
no,
kind of,
no.
Okay.
That wouldn't change. That wouldn't change anything. No, no split adjusted then the price. So if you look at our portfolios, what we're trying to capitalize on with a Palantir, for example, are the next stages of this AI revolution. What we're seeing in the GPU side of things is NVIDIA, all praise to Jensen Huang. I mean, just unbelievable company execution, vision, and so forth. And it's not over. It's going to last a long time. But there are going to be many other companies benefiting from AI. The productivity lift alone is going to be massive, the most massive productivity lift in history, we believe. And so this AI revolution is going to be broad-based and is going to benefit a lot of companies. On the GPU side, of course, we have AMD as competition, but many people do not understand that there's a lot of other surreptitious competition evolving out there. Each of the hyperscalers is evolving its own chip strategy. You have a Tesla that has designed its own chip for an AI chip for the more specialized autonomous driving opportunity. And I think you're going to see a lot of companies developing more specialized chips. We know that NVIDIA, of course, will segment the market as well. So we just think that a lot of the assumptions for NVIDIA, that this is NVIDIA's market and it's alone, that those are changing.
ARK Investment CEO Kathy Wood there speaking to Bloomberg's Carol Massa. Take a look at some of the stocks that we're watching when the markets open in Hong Kong and across in mainland China in the next hour. And watching, of course, a lot of these chip and AI-related names. NVIDIA and other tech names fell in the US on Friday amid significant profit taking. We're already seeing that reaction across some of the relevant names in Korea and Japan there as well. Also, retail, fashion-related sectors. Gap's retail and wholesale peers also in focus. It reported fourth quarter earnings that exceeded expectations. So watching for some of those suppliers and relevant names in the Hong Kong and mainland China sessions as well. In the next hour, we'll get more analysis as well. Of course, the curtain falling on China's 2024 MPC session. Here, why autonomous research found the event underwhelming. That is it for Daybreak Asia. Our markets coverage continues with the start of trading in Hong Kong.